Everyone, welcome back to the TraderLion channel. This is Richard and Ross, and today we're continuing our America's Greatest Companies series, talking about Amgen, ticker symbol AMGN, which is a fantastic biotech company. And today we're focused on this period from kind of 1989 to the next kind of 2 years or so. And during this time, it kind of increased from a split adjusted price of $8 to almost $80 a share. So basically a 10x in just a year and a half or so. A really fantastic uptrend. And overall, looking down at the fundamentals, the reason for this move, Ross, if you can kind of scroll down for just a second, the reason for this move was its kind of revolutionary product, which helped boost your immune system when you're going through chemotherapy. So you've got that N in Can Slim there with that new drug, and some known facts at the time of the breakout: acceleration in quarterly earnings from 0 to 300% to 700%. Quarterly sales acceleration from minus 46% to plus 46%, 84% to 207%. And you can see after-tax margins as well at 12.2%, up from single digits in the last 8 quarters. So significant earnings, sales, and all those CANSOM characteristics before that first 5 points. So once again, just because a stock is already posting fantastic results doesn't mean you've already missed a stock. And all that's left to do really is to buy it at a proper buy point. So to start things off, we'll look at a weekly chart, and then we'll move on to a daily chart in MarketSmith later. But overall, Ross, I'll hand it over to you and talk about that first buy point and that first base right here in 1989.
All right, sounds good. Thank you, Richard. So here we are looking at the weekly chart as discussed. The base we are starting to analyze, and keep in mind this is all post-split prices. So when these original buys were going on, we were not looking at a stock at $8. It was roughly in the 60s at this point. So just wanted to point that out. So anyway, what we're looking at here, and as we get started, you can see we've got a follow-through day marked here. But one thing I would point out is you can see as the market is, overall selling off during this point, you've got Amgen actually working its way up the right side. So at this point, even though we don't have a relative strength line on this chart, I'm gonna, just by looking at the price action versus the S&P at the top, my best guess is if we were looking at a, daily chart in real time, we'd start to see some relative strength divergence to the upside. Anyway, that being said, here is our, the first base that we're looking at. This is your classic double bottom base. I would even tell you this is your base on top of another base here, which we're not going to get into analyzing, but at a glance, you can see the big upside volume, the lighter downside volume. So I love to see a structure like this built on top of another one. That just adds to the launching pad effect, if you will. It just makes it that much more powerful, and you've got that much more rocket fuel behind it, a little more power there. So there's a couple ways to approach this. The first is obviously the early way in. That would be noticing this double bottom base as it forms. There's a rule that was ultimately created for that. It's called the Shakeout +3. Ultimately, that's letting you see a double bottom base forming or in the making rather than waiting for it to happen. And the way that works is, and here's your classic double bottom base, or the W, where here's our first leg down and first bottom. Here's our second leg down and second bottom, where we've undercut the first. That's a necessary part of a proper double bottom base. So once you've got this undercut going, you've got that potential for a double bottom base to form. And so what we're looking at is what was the actual low price, the dead low of this week. And we then want to add 3 to that on the way back through. And remember, this was not an $8 stock that obviously on a percentage basis, that would be ridiculous. This was in the mid 60s. So keeping that in mind, whatever that low is on the way back through on the upside, you add $3. Once you're through that $3, you're at that $3 plus point, even if it is prior to your proper entry at that double bottom, that is your entry point. That's your clue that you've got a double bottom in the works. I will say this though, if I'm looking at a shakeout +3 or something like this, where I'm trying to work my way in a little bit early, and if that point isn't significantly earlier, if it doesn't make sense for me to, if it's not worth the risk, if it's just, if I'm too close to where resistance is and there's not enough things work, that again, this is something that you want to pay close attention to. Volume is going to be very important, especially when you're trying to work your way into something like this early. So again, if it doesn't make sense, if you're only working your way in 30 or 40 cents early on a mid $60 stock, you have to ask yourself, what kind of volume is going on here? What's the market doing? What's going on? Is it worth me trying to squeeze in only 40 cents or 30 cents or 60 cents early to be buying before the quote unquote resistance has been broken, before the volume is there? Because that's going to make a huge difference. It could be the difference between getting shaken out and, which not only, messes up your potential average price, assuming you're going to revisit the stock, but it also takes a chink out of your psychological emotional armor. So nevertheless, that's your early way in. If you are finding that double bottom base in the making, that's your Jesse Livermore, shakeout +3 and your early way in. Now, let's assume that's not your style. The proper way to buy that double bottom base is after the undercut of that first low, and on the way back up here, you're buying. The pivot point is the middle of the W, right where we've got that red line there. And so here is the first point where you could potentially buy the stock as it's breaking up through resistance. There's not a whole lot of volume going on right at that point. You see volume doesn't really come into the stock until this week here, and you've got the powerful move. So again, this is going to be more, let's say you don't get the volume, and this does happen. Sometimes a stock's going to cross through a pivot point and you may not get the ideal volume. Maybe it will be a little bit wedgy. And we'll take a look at this on the daily. Maybe that's not being picked up here. Maybe on a daily chart, you are getting the volume to buy. And I'll just make the point, even if not, and you're waiting for that proper weekly chart to show up, there's nothing wrong with buying that, buying the stock right here after some tight action, big volume, it explodes to new highs, well above the highs here, which, you're not getting the benefit of the cheaper prices or the lower prices down here. However, you are through resistance, and you can see what ultimately happens. Let me clear up some of this mess I've got written all over it. The stock acts like a champ. You've got an institutional quality name. You've got 4 weeks super tight that never closed below once it broke through resistance, that turned it into support, held it the entire time, and immediately developed a respect for its moving average here, which is its 10-week line, or its 50-day moving average. And if you'll notice, the personality of Amgen is to respect that moving average until it's ready to build a base. And you can see here, we build a new base and set up and go again underneath the 50-day the entire time. We never close below until that time. Again, once we start closing below the 50-day moving average again here, we wind up building a new base, and Amgen gives you, a way back in. So depending on, remember, there's no right or wrong way to play it. The only right way is to, I would tell you this, the only right way is what's right for you, as long as you're managing risk. But, it obviously is going to make it your average, where you bought it, where you've added, how much progress you're making in the rest of your account, where everything is in general, that sort of thing is always coming into play. So let's not get too far bent out of off topic here. Did you want to say anything, Richard, before we?
Yeah, I'll just add a couple things before we go over to the daily charts and really look at these bases more in depth. But yeah, the first thing I'll say is right here, we've got a correction in the SPX here. And this day that forms the second bottom, the double bottom, we have a really nice push off the lows. So during a correction, a weekly closing range of greater than 40% is considered accumulation. So even though this is big red volume, is actually a positive because this closing range is definitely higher than 40%. It looks even higher than 50% here. So that's one thing to point out. Then, like Ross said, we've got a great respect the 10-week. And then here, once again, we get the SPX, which really takes a hit, a really big hit. And AMGen during this time period is just kind of fighting the market. You can see it's choppy action, but it doesn't want to, it's not declining nearly as hard as the overall SPX. So its RS line is maybe even increasing during this time. And then we form this nice kind of stage two. Once we get that follow through day, this one just rips. As we always like to see, we want to see good RS during a correction. Those are most likely to be the leaders. And that certainly is true with this one. And once the market follows through, this just takes off from 17 to 38 in just a matter of weeks, really, and shows extreme respect for that 10-week, 50-day. So yeah, those are the only things I'd add, but definitely a super powerful move. And yeah, like Ross was saying, there's so many different ways to play the double bottom. Really what you're looking for is a place to manage risk. And however you want to do that to fit your personality, that's the way you should do and what you should follow. So let's move on to the daily chart on MarketSmith and talk through these bases a little bit more on a granular level. All right, so here we are looking at this first double bottom base, and you can see that it's not split adjusted yet. So we've got the breakout at around $60 a share instead of 10. And here you have the first leg down, and MarketSmith pattern rec picks it up right here. Then you have this nice push and support off the lows on high volume. That's constructive. And from that point on, if you want to play that undercut and rally and shake out +3, you can, or you can kind of wait until it moves towards this resistance point, the middle of the double bottom at 55.5. And here I would say you'd probably be buying through this point. This is a little bit of a consolidation pivot, or even a kind of downward trend line. You could draw that in as well. So there's definitely places to get in to manage your risk here near that double bottom pivot. And from there, it shows really nice respect for the 10-day as well as the 21 EMA, or that could be the 23 EMA here. But regardless, really strong respect for those key moving averages, just grinds higher towards the next base. So with that, let's move on to the next base.
And I would just say that so we can, just in case anyone in there, going back to that shakeout +3, it becomes a lot more clear here. So 47.25, that's telling you on this shakeout on the recovery through 50.25, add 3 to that, you could start to buy. So in this case, it makes sense. You want to be careful, right? 50.25 is below the 50-day, but it's well below your, you're getting a solid early start there. So it makes all the sense in the world. At this point, so what I'll do often is I'll look to the left, right, at this point, just to see what shorter term moving averages you're respecting, what you might respect after some strength. And so as we look to the left, you can see it's 10-day, gets a little respect. It's 21-day, which obviously continues as you look forward, but you don't know that yet. So, if you're buying through 50, a little bit under the 50-day, you can at least, after looking to the left, maybe use its 10 and 21-day moving average, which actually happens to work, keep you in there perfectly and keep your risk at a minimum if you decide to do that. So anyway, I just wanted to give a little clear that up since we can see it a little bit better on that daily chart.
All right, so moving on to the next base here, you can see that the SPX really declines hard. And this stock is getting wide and loose, but at the same time, it's trying to fight the market and stay up there and fight this overall downtrend. So it's really showing extraordinary strength here. And you can see that in the SPX line. Even though the SPX is declining and the stock actually pulls back, it's either flat or increasing in terms of that RS line, which is the price of the stock divided by the price of the SPX. But overall, it can't fight the market forever, and it does end up building out a base here. And you can see we did have another split here. So that's why this breakout is once again around 50. But overall, a nice looking base going from 50.5 down to 40.63. No real huge down volume. You do have one day here. But overall, nice and clean cup breakout right through 50.5. And from there, it shows, once again, nice respect for short-term moving averages, and then really accelerates to the upside here, going all the way from 50.5 to 100 in just a very short amount of time. You can see it's a really strong, powerful move from the pivot, plus 85% in just 74 days. So a very strong move. And even if you missed the double bottom base here, you should have picked up the RS line outperformance, especially because it should have been standing out and on your radar as it tries to make new highs during a correction here. And then very clean breakout And once the overall market follows through, that's when it really takes off. So yeah, I think that's pretty much it for this base. Ross, anything to add here?
Nope, I think you've pretty much covered it. You know, I would point out, like we discuss on so many of them, even though you don't get a perfect respect for any one moving average here, you do have it's super liquid, and the way that it does respect moving averages at least allows you to manage risk and work your way back in with confidence. And if you buy them right and you're managing risk, again, I'm just pointing out they keep you in it. They give themselves to you as long as you don't.
Right.
As long as you don't panic out before your rules tell you to. These things really just they tell you what to do with them. So anyway,
For sure. Yeah, that's great. And let's move on now to the next base. All right, so here we are moving forward. This is kind of where we ended on the last screen. Then it moves sideways for a few months, forms another double bottom base. And this one takes a little bit longer on the right-hand side to push up here. And once again, you could have used that kind of shakeout +3 here, but it also kind of offers a nice kind of consolidation pivot down here. Minervini cheat entry, you can also call it. But there's no harm in just waiting for the standard breakout at 44.43 or 44.33 here and waiting for that, which also pretty much lines up with all-time highs at 45.66. Regardless, moving on, it shows nice respect once again for shorter term moving averages. And you also have a nice upside reversal here. And this is why we like during a bull market to wait until the end of the day before honoring our stops, just because a lot of the time stuff can really recover from the morning. It might look horrible intraday, but often enough, the strong liquid names that the institutions are piling into will get supported by the close. So with that said, moving forward, we've got another pullback to the 50-day and then a quick move up here before forming a late stage base. I believe this is actually a stage 6 picked up by MarketSmith. But regardless, obviously with a later stage base, the probabilities of that breakout working decrease a little bit. And we do have it kind of fail here before finding support near the 50-day and having a last move up here before topping in an intermediate sense at 78.13. So Ross, anything to add about this kind of last move upwards?
you know, no, you've got that climaxy breakout. It's kind of a weird thing that just, as we know from here, fizzles back below its 50-day and doesn't really do much again after that.
Yep.
So, I mean, all I would say, this is one of those things where the moving averages is going to ultimately save you, where we know that during a run, it's ultimately going to either hold its 21-day or 50-day. And once it's below that 50-day, you're back into base building mode for the most part. For how long is anyone's guess. So again, unless you've owned the stock maybe from its original breakout, that pre-split breakout, which $8 on the weekly chart if you're looking at it post-split, but in the 60s if you were originally buying it, then you can use your 200-day moving average on as much of that position as you want. However, for those of us that may not want to sit and have quote unquote dead money that long, that's typically how I'll do it. Is once it's below the 50, because we know Amgen shows you once it's below there, you're back in wait and see mode. I'd rather pay up for the stock a little bit later and have the money that would otherwise be sitting in Amgen while it chops sideways in something else that's working. And we keep alerts on Amgen for a revisit. Just risk reward. That's all. Simple.
For sure. And just going, if you could go forward just like 1 or 2 months here, we'll see kind of how the character of the stock changes a little bit. It gets a little bit wider price action wise. It just doesn't quite act the same during this. You can see here, very volatile over here on the right hand side versus kind of very tight action from these breakouts. So something to keep an eye on. And this doesn't die immediately. I think O'Neill mentions in the document that it was basically a 50 bagger during that decade, the 1990 to 2000. So depending on your time frame here, you certainly could have held this longer if you have a very low cost basis and of course manage risk along the way. But
and I don't mean to cut you off. As we say, check this out, right? So as soon as you're back below this 50-day moving average in base building mode, guess who's going to be? Whoever's, now you're not holding the 200-day. So much easier to just kiss it goodbye here. It's a super liquid name, and then keep alerts on it and you might even be able to revisit earlier on strength on the way higher. It's not always going to be at higher prices. So that actually works really well for this one, even though it doesn't hold it. It's not one of those ones that holds it perfectly throughout the length of its run. It respects it enough that it can be used to understand its personality and manage risk in super efficient manner. So
100%. And regardless, Amgen, a great stock to study, both in terms of the double bottoms as well as those shakeouts. And yeah, one of the greatest stocks of all time. And with that said, thanks for watching. If you enjoyed, go ahead and leave a like down below and subscribe if you're new to the channel. And we'll see you guys in future videos.